Indeed, we've seen not only Treasury rates fall, but maybe the catalyst for Treasury rates falling actually started overseas. Whether it's the UK or the European Union, their PMIs were weak, and then coming into our time zone, we were already pressured. Look at a two-day of 2-year. You can see we're under yesterday's lows, and if you look at a two-day of 10-year, same dynamic. 2-week lows in Boons down they're down 14 basis points, pretty much the same as gilt. And the big story today might have been 306,000 on early benchmark revisions. We'll know for sure in February next year on the job front. Maybe it's less than we expected, but it still draws attention to the fact we make a lot of assumptions on the labor market. But we don't want to make any assumptions about tomorrow. Let's talk to a trader. Mike Palmer.
Hey, Rick.
How you doing? Okay, bump, shake. This is the big guy, and what we want to ask Mike is very easy. I see that rates are moving lower, which means Treasury prices are moving up. But more importantly, I see that the VIX is moving down, and we're seeing very strong buying on lighter than expected volume in equities. Your thoughts?
Light volumes is very typical for what we usually see in August. This is a quiet, listless market. I don't think anybody's really concerned about Jackson Hole. I don't think that that's looked at like a volatility event. We'll probably hear something akin to we're keeping a close eye on inflation, and also we might have one more hike left in the cycle, and that's it. That's the message discipline we're used to. So it's very rare that we get a volatility event out of Jackson Hole, and that way it's probably similar to Davos in the winter, where there are not big volatility events. That said, if we have a deviation off that, we could have a move in the market related on what happens there. But
now, as I look up and I see these moves, it certainly seems as though there is some type of nervousness regarding what could potentially happen in Jackson Hole, because it seems as though all the trends we had prior have been broken. Equities were in a soft mode, moving lower, and interest rates last week had breakouts to the upside. Do you think this is more of a reversal of those trends, or potentially just a temporary hold?
I think it's a listless market. I think August is quiet. You know, everybody's on vacation. I think when we get back after Labor Day, when everybody's back in the office, there's no more vacations, people are going to reassess the numbers. They're going to look at where our interest rates are, where equities are. They're going to look at it from sectors and reassess. Now, I don't know if that means we go higher or lower, but I think in the interim, we're going to see these low volume days where we move about 1%. With the VIX at 16, that's what you expect. We move 1%. VIX is 16. We've moved exactly 1% today. So I don't think we're doing anything out of the usual in the moment. But, you know, we could have catalysts going forward that could create some volatility.
Now, one of the catalysts that many talk about, and we only have a few seconds left, is whether it's today's PMIs, Europe and the UK all of a sudden seem to be either quickly going towards a recession or in one. Final answer, do you think that could have a negative effect on what seems to be a strong U.S. economy?
There is a contagious effect around the world, whether we see things like interest rates spike higher, inflation spike higher, something happen abroad. There is a contagion effect that happens. They have a problem, that volatility will drift into our markets. Whether that's a real event, we don't know yet. Whether that really kind of manifests itself in true volatility yet, but that is something to look at.